Your credit score, it's more than just a number. It can open doors to financial freedom or slam them shut. But what if something crucial is holding you back? The answer lies in the three C's of credit: character, capacity, and capital. These elements shape how lenders view your financial reliability. Do you truly understand where you stand? The first C, character. Character refers to your credit history, which represents how responsibly you've managed debt in the past. Lenders use this history as a predictor of your future financial behavior. It encompasses factors like your payment history, the length of time your accounts have been open, and the types of credit you have used. Key factors influencing character: payment history. Your track record of making timely payments is one of the most significant aspects of your credit score. Consistently paying your bills on time helps build trust with lenders, while missed or late payments can significantly damage your credit score. Length of credit history. A longer credit history indicates more experience in managing credit, which can help improve your score. Lenders prefer to see that you have a proven record of handling credit responsibly over time. Impact on credit score. Character is a major factor in determining your creditworthiness, accounting for approximately 35% of your overall credit score. A solid history of timely payments and a longer credit history help increase your score, while missed payments and a short credit history can lower it. The second C, capacity. Capacity refers to your ability to repay debts, which is determined by your income and overall financial situation. Lenders assess whether you have sufficient income to meet your monthly debt obligations and whether you are taking on more debt than you can handle. Key factors influencing capacity. Debt to income ratio. This ratio compares your monthly debt payments to your monthly income. A lower ratio indicates that you have more disposable income available to handle additional debt. Lenders generally look for a debt-to-income ratio under 36%, though this can vary. Income stability. Lenders also evaluate the stability of your income. Those with steady employment or a consistent source of income are seen as less risky. Conversely, irregular income or frequent job changes can raise concerns. Impact on credit score. Capacity doesn't directly affect your credit score, but it plays a critical role in your ability to manage debt. A higher capacity, meaning lower debt-to-income ratio and stable income, shows lenders that you can handle your credit obligations, which may lead to better loan terms or higher credit limits. The third C, capital. Capital refers to the assets or savings you have available. Lenders look at your capital as a cushion that could help you meet debt obligations if your financial situation changes. Having substantial capital reduces the perceived risk for lenders, as it provides them with a sense of security should you encounter financial difficulty. Key factors influencing capital. Savings accounts and investments. Having money in savings or investments shows lenders that you are financially stable and can handle unexpected expenses. Property and other valuable assets. Ownership of assets such as real estate or vehicles can also be a sign of financial security, suggesting you have resources to rely on if necessary. Impact on credit score. While capital doesn't directly influence your credit score, having sufficient assets can help improve your overall financial profile. In cases where lenders are on the fence about your ability to repay, a strong capital base can give you an advantage. How the three C's work together. While each of the three C's, character, capacity, and capital, plays a distinct role, they are interrelated in how they affect your creditworthiness. Lenders use a combination of these factors to assess the overall risk of lending to you. For example, even if you have a strong character with a history of timely payments, a high credit score, a low capacity, high debt-to-income ratio, might make lenders hesitant. Conversely, someone with strong capital might still face challenges if their character, credit history, or capacity, income stability, doesn't align with lending requirements. Credit scoring models like FICO incorporate all these factors, resulting in a comprehensive score that represents your financial behavior. Although individual scores may differ slightly depending on the model, understanding these three key areas gives you a clearer picture of what affects your credit score. Conclusion. A strong credit score opens doors to financial opportunities, but here's the twist. It's not just about one factor. The real key lies in the three C's: character, capacity, and capital. What happens if one of these falters? A small gap in any area could be the difference between approval and denial. So are you truly ready to unlock your financial potential? Or is there work left to do? The choice is yours, and the stakes are high. Will you master the three C's before the next opportunity passes by? Subscribe for more finance insights.